Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for this Wednesday, July 8th. My name is Ian Saunders, and joining me here this week is Eric McCardle. And Eric, we're coming in this week to following a pretty strong, shortened week for most major domestic equity indices there last week, with the 4th of July holiday coming in there over the weekend. Coming in here to a little bit of a pretty strong movement earlier on, and then some back and forth movement. And some back and forth movement, especially that we see continuing today. But nonetheless, at least at the time of this recording, most of the major domestic equity indices posting gains, somewhat muted, but still gains currently. And coming in here to look at the chart of the S&P 500 here on the Nasdaq Dorsey Wright Research platform, we're going to go back to the chart that we have been tended to follow more frequently, at least recently here. It's going to be that 20-point chart of SPX here on the page. In order to navigate to that chart, you can go over to the left-hand side and click on the other scales, the 20, and it will bring up the chart that looks like the one that you see here in front of you. And as we discussed, we saw this chart obviously fall off pretty significantly, reaching that low down there at 2,200 at the end of March, and then rally pretty significantly there since that time. But over the past few weeks, and a little bit of, as we were talking, a little bit of battle trying to play out there between supply and demand, some flip-flopping of signals. We saw a buy signal given there at 30.80 in early June, reaching a near-term high there at 32.20. And then reversing lower to give a sell signal, followed by a buy signal. And then ultimately, we've risen back here recently to flip back to a buy signal up there at that 31.60 point, and continued a little bit higher there, at least at the chart level of 31.80. So we're still currently sitting on a buy signal, approaching that near-term high that we saw there in June. Coming in there with initial support at 3,000, and then further support right beneath it at 29.80. So the 3,000 level has seemed to be a pretty significant point for a lot of investors, and definitely certainly a lot of traders. It just has thinking about it in your head, the 3,000 is obviously a pretty significant number, and has certainly seemed to play out in that way there over the past few weeks. Looking down beneath that, we see that further support would be coming in at the 27.80 down to 27.40 point, which is now bumping right up against where that longer term positive trend line is on this chart down there at 27.20. So the one good thing about the volatility is that it has led to several support levels here, both on a near term and then a longer term basis as well. But taking a step back and looking at the broader index, still moving higher, still on a buy signal, still seeing that large cap dominance displayed on behalf of domestic equities there, Eric.
Yeah, that's right, Ian. And as you mentioned, that supply and demand battle, and looking at the consolidation that we've seen in the near term, but of course reflecting back on the strength of the index coming off that March market bottom. We would like to see a little bit more confirmation with the move past resistance here, but overall the technical picture remains strong and intact. On the other foot, Ian, when we look at domestic equity indices and their respective ETFs that track those indices, the Nasdaq 100 has continued to move to all-time highs, ultimately culminating with a new all-time high yesterday at 10,700 on the default chart. We look at the ETF for the Qs, QQQ. Of course, we're going to see that chart really reflect the index strength, right, as it is tracking that index directly. So marking a new all-time high yesterday at 260, and the Qs posting a near perfect fund score of 5.89 out of a best possible 6, with a return on the year of nearly 21%. So pretty remarkable, right? Because the S&P 500, which on a relative basis is still looking pretty strong against global asset classes, still in the red on the year, right? And whereas we have the Nasdaq 100, which is solidly in the black and really continuing to show dominance. So, just an interesting dichotomy there. But Ian, when we look outside the U.S., we've seen some surprising strength coming out of one country. Is that right?
Certainly, and one way that we can look at some of the strength between various places across the global markets in general, right, is through a page we have here on the platform called the Asset Class Group Scores page, which is going to take all ETFs and mutual funds we have on the system and classify them into at least one of 135 different groups, really meant to represent your full investable universe around the world. So including your domestic equity sectors, your stocks and stock classifications, fixed income classifications, as well as some individual international countries and regions, like you mentioned there. And one thing, just from a broad perspective to note, is that we've seen with this kind of global equity rallying over the past few weeks here, seen a lot more groups rise in these rankings. These rankings are going to be taking each of those respective classifications and taking each of the funds within them and averaging their fund scores together. As Eric just mentioned, that fund score goes from 0 to 6, 0 being the worst, 6 being the best. And we're going to average each of the fund scores for each group, right, in this page to give us an average score for the group as a whole. And each group is then going to be ranked accordingly. And so we're now sitting at 37 groups that's scoring in what we call the blue sky zone, which is having an average group score above 4.0, or our ideal score territory, as we call it. And one of the groups that might come as a bit of a surprise on the international side, especially, is China. We've seen China rise very significantly there in score recently to come in at an average score of 4.93. Making it the highest scoring international group. And that's a position that's actually maintained throughout pretty much this entire rally we've seen for global equity markets since the end of March there. Most of the other international groups you're going to see on the page are going to be found quite a bit down towards the bottom of the page, most of which actually at the bottom of the page, looking at areas like Latin America, Brazil, India. Haven't seen as much of a pop there as China, but China is shown been able to maintain that strength and improve its strength relative to the rest of your global investable universe there, to now come in at its highest score ranking since late 2017 there at 4.93. We also note that China has a very significantly positive score direction at 2.87, ranking among the highest, at least, of these groups that we see here above that 4-score threshold. So definitely interesting to see there, and again, somewhat surprising, maybe pending around the headlines, you continuing to see that U.S. and China tensions are continuing to increase there, continuing to butt heads. But nonetheless, we've seen Chinese equity markets continue to rally, really on the backs of one of the strongest single days for Chinese equity markets this past Monday. And there's a few different ways that you can look to play those here on the platform. One, specifically the broadest example you could come in and take a look at would be to simply use the Ideas tab here directly from this Asset Class Group Scores page. Using this link here is going to bring up each of the different funds that we use to classify in that group to give you a lot of different kind of ideas that are each going to be sorted there by fund score. But another way that you can come in and take a look at is actually going to be through one of the models we have here on the Dorsey Wright Research platform that you can get to up top by going to Models and Products and then clicking on Models. And that would bring you up to the broader models page. And then you can type in up top, type in Crane Shares to take a look at the Crane Shares Dynamic China Rotation Model, which is a China-focused model that we have here on the platform that seeks to be invested in Chinese equity. But it does have the potential to move to become defensive through Chinese fixed income if not enough of the equity funds pass its relative strength test. So when coming in here and viewing the model, and you can view more information on the model by clicking on that model line to bring up this nice pop-up here on the right-hand side. Viewing further information can be found there through the info file if you want to get more into the weeds for this particular model. But in coming in here and clicking on the holdings, we can see that we actually did have a recent trade earlier this week where the Crane Shares CICC China Leaders 100 Fund was purchased by the model there actually yesterday morning to now make all of the equity-focused funds the model could potentially invest in, and all 7 equity-focused funds included in the model inventory are now held in the model, which is a continuation of that follow-through strength that we've seen on the backs of the China strength in the group scores, on the backs of the outstanding performance that we've seen there over the past few weeks. Good to see that increased participation there for the Chinese equity space, with a pretty broad representation here that we currently see there in the Crane shares model. In order to follow this model, you would follow it the same way you would any other on the platform. You can click on this little bell icon directly there under the actions activity column to be notified of any potential changes moving forward from here. But definitely a strong sign to see that relative strength continuing to increase. And we've seen the relative strength increase in a few other areas outside of maybe the equity market as well. Is that right, Eric?
It is, Ian. And if we're able to flip back over to that asset class group scores page, and just a general observation on that front, we've talked in some of our recent content about the strength of domestic equities, such as the S&P 500. We talked about the Chinese equities really leading the international space. What we haven't talked about today are the fixed income groups that are in the top blue section. And overall, we don't want to spend too much time on that today, but another group that really stands out here is the precious metals group, and which has been extremely resilient, scoring in that 4 or above threshold with a strong positive score direction. And that's really been led, of course, by gold, which, if we take a look at the chart of GLD, the Spider Gold Trust, which is going to track actual gold bullion, so very similar to, direct exposure to the commodity. This is moving to a multi-year high for GLD, the highest the fund has traded since 2012. When you look at the actual commodity on our system, GC / for gold continuous, it's at the highest level since 2011. So extremely strong here. When we're looking at GLD, we have multiple consecutive buy signals, trading above that bullish support line, and posting a fund score of 4.41 with a return on the year over 18%. Now, I mentioned the complement to gold as far as other precious metals, and we've really seen silver start to heat up here recently. One such example being the iShares Silver Trust, ticker SLV. And with today's action, we see this ETF moving to a second consecutive buy signal with a double top break at 1725. Not quite the same returns as GLD has had on the year, but in the black nonetheless, and a lot of strength off the recent bottom to give it a 5.27 fund score with a score direction of 3.25. So a lot of strength there, whether you're looking at gold, whether you're looking at silver from a commodity standpoint. Ian and I were also looking prior to recording this at the miners, right? So whether you're looking at gold miners or silver miners, stocks and respective funds that track those companies are also doing very well, as you might expect when the commodities start to boom. So just an interesting area to keep an eye on. Oftentimes the precious metals are associated with expectations of inflation in the future. And, while we don't necessarily want to speculate too heavily on where those expectations might be pointing right now, you're certainly seeing the action in terms of demand in the market moving into assets like this. And then to a different extent, inflation protected bonds, which we're not going to really talk about today, but you're starting to see, like I said, some demand move into asset classes that would really benefit from an inflationary environment. So something to keep an eye on, something to mix up the exposure a little bit. We know that obviously, you've got your domestic equity pieces, your fixed income pieces, but it does make sense to have commodity exposure in some parts of the portfolio. And right now, these two precious metal groups are certainly worthy candidates of filling that spot. So with that, Ian, I think we've about covered it for today. For you all listening and watching the YouTube version of this podcast at home, thank you for tuning in. Feel free to give us a call at 804-320-8511 if you have any questions about anything we covered today or anything Nasdaq Dorsey Wright related. Additionally, you can email us at dwa@dorseyWright.com. Until next week, hope everyone has a great rest of their week and a nice weekend.